What's up guys, and welcome to WSM Research. Today we're talking about a recently IPO'd e-commerce company that is disrupting the second-hand fashion industry. Poshmark Inc. IPO'd on January 14th of this year with a lot of hype. They priced their IPO shares at $42, giving the company an equity valuation of $3 billion. Remember that only big institutional investors can buy at the IPO price. Retail investors have to wait until the shares start trading on an exchange. Unfortunately for retail investors, shares began trading at $97.50, more than double the IPO price, and closed the day up more than 140%. However, in the 2 months following the IPO, almost all of the IPO hype has disappeared, and shares have tanked 45% down to $45.55. This pullback potentially gives individual investors the opportunity to buy into this rapidly growing e-commerce play at a relatively cheap valuation. In this video, we'll go over the fundamentals of the business, as well as their financials and valuation to see if this is a compelling opportunity. Keep in mind that we are not financial advisors, and this video is for entertainment purposes only. Make sure to do your own research and consult with a professional before making any investment decision. Poshmark Inc. is a social commerce marketplace similar to Etsy and eBay, where people can buy and sell used clothing, shoes, and accessories. New clothing is a massive expense for young people. They often buy so much clothes that their wardrobe is overflowing and they end up having to throw away half of their clothes at the end of each year. This isn't just a waste of money, but also a huge environmental problem, because most of the clothes are thrown away and end up in landfills. Poshmark aims to solve this problem by giving consumers an easy way to resell their used clothing. This is a win-win because the seller gets paid for their unwanted clothes that would otherwise be thrown away, and buyers get access to high-quality brands at steep discounts to retail prices. Poshmark makes the entire process very simple. To put an item up for sale, you just have to take a picture of it on the Poshmark app, and it can be on the marketplace in less than 60 seconds. Once the item is sold, you print out a prepaid shipping label and put the item in your mailbox to be shipped out, and you'll receive a digital transfer of the funds once the item is delivered. Young consumers increasingly care about sustainability and view fashion resale as a way to reduce their ecological footprint. Every year, competing resale marketplace ThredUp publishes industry projections for the resale sector in conjunction with consulting firm McKinsey. In their 2020 report, they expect the secular tailwinds of sustainability to drive 39% yearly growth over the next 5 years to reach $36 billion in 2024. This represents a 5-fold increase in the resale market, while traditional retail is expected to decline 4% during the same period. The growth in the resale market is manifested by increasing consumer acceptance of second-hand products. In 2016, only 45% of women reported that they were open to buying second-hand clothing. In just 3 years, this number increased to 70% and will likely continue to grow year over year. Most of this increase came from younger consumers, with 40% of Gen Z shoppers having bought secondhand apparel, footwear, or accessories in 2019. Younger generations prefer to prioritize sustainability and experience less social stigma against secondhand goods compared to older generations. They also view secondhand as a way to cut costs when money is tight. Poshmark has benefited tremendously from these tailwinds, with active buyers growing at an astounding CAGR of 40% over the past 2.5 years. Now let's take a look at their financial statements. They only just went public this past January, so they currently only have their S1 filing, but it still gives most of the important points of their financial statements. We consolidated the essence of their comprehensive income statement to see how profitable of a business it actually is. It turns out that there is actually a lot to like about this company's operations. If we take a look straight at their bottom line, you'll immediately notice that they are in fact profitable on the basis of generally accepted accounting principles, but that is only a small part of the whole story. This company is growing rapidly, and in 2019 increased revenue by more than a third. Based on the first 3 quarters of 2020, the extrapolation for the full 4 quarters is that 2020 revenue will come in at $257.7 million, a 25% increase over 2019. Even more promising is that their gross margins are very good for a company with such good growth. Their gross profit expanded from $106 million in 2018 to $142.9 million in 2019, almost a 40% increase as a result of growing revenue and good gross margins. In 2020, the expected gross profit increased to $178 million, a 25% year-over-year increase. Compare that to so many other recent IPOs that have operating expenses that are far greater than their revenue. On the other hand, their growth is not free. They invested $88 million in marketing in 2018 and another $132.5 million in 2019. In 2020, they will have spent $87.3 million on marketing. In addition, they spent a non-trivial amount on research and development, presumably going towards things like developing their website, apps, etc. Another $28 million in 2020 will have gone to general and administrative. These are not direct costs of sales and should not be considered in the same vein as things like cost of revenue and operations expenses. Cost of sales and other operating expenses will scale with revenue, meaning that if they triple their revenue, you would expect operating expenses to roughly triple as well. On the flip side, something like marketing expenses or research and development has little to no direct correspondence with revenue growth. If the company triples its sales, it is free to decide whether or not to increase marketing spending or not. If the company feels that spending on marketing will continue to be a good investment to grow the business, then it has that option. Otherwise, it could keep marketing expenses constant or potentially even scale it down to increase profitability. Take a look at this chart of Poshmark's revenue and expenses for the full year of 2019. It is coded by green for revenue, red for gross expenses, and orange for other expenses. Gross expenses are in red because they are the expenses that the company probably won't be able to avoid as it grows. On the other hand, some of the other expenses may be reducible. In particular, marketing is by far the biggest expense and is definitely something that can be reduced in relation to revenue. In 2019, Poshmark took a $14.5 million loss. If they had just reduced their marketing expenditure by 10%, that would have pretty much canceled out the entire loss. And that's not even considering any potential efficiencies of scale that might come out of research and development and SG&A. That's not to say that it isn't smart to spend on marketing and try to grow the business. It just shows us that the business itself is inherently profitable. In 2020, probably as a result of the pandemic, Poshmark took advantage of this fact and reduced marketing even as revenue was increasing, allowing it to easily post a GAAP profit. Finally, let's finish up with valuation. Poshmark just went public a few months ago and immediately spiked by more than 100% out of the gate. However, it has since given up all of those gains and now trades at a relatively modest $45.79 a share. That puts its market cap at around $3.34 billion. That's less than 13 times expected 2020 sales, a very reasonable valuation for a company that's growing as fast as Poshmark is. If you consider price to gross profit, it's less than 19 times expected 2020 gross profit. They also have very little net debt to speak of, and in fact have an almost negligible negative shareholders' equity of negative $97 million. If this current trajectory continues, it will be very favorable on a fundamental basis for profits in the future. Overall, Poshmark is a rapidly growing e-commerce platform that will likely continue to benefit from industry tailwinds in the coming years. The main risk for Poshmark is that the online resale market is intensely competitive with low barriers to entry. They have many competitors, including Versatare Collective, ThredUp, and Etsy, just to name a few. But with over 6 million active buyers, Poshmark has proven themselves as a market leader, and if they can keep their current market share, they will grow strongly with the whole industry. Alright guys, that wraps it up for this video. If you like this content, don't forget to like, subscribe, and share. If you have any thoughts on Poshmark or any other stocks you think are more interesting, let us know in the comments section below. As always, thank you so much for watching, and we'll see you in the next one. WSM Research, signing out.